Hello and welcome. Thank you to the Financial Academy for inviting me today to speak on this presentation on finance, specifically centralised and decentralised finance. I'm Professor George Babiris, and I'm also involved in the funds management global industry, managing investment mandates on behalf of sovereign wealth funds and pension funds around the world. So today we'll go through the module and use some real-world examples that are contemporary and in use today. The table of contents, we'll go through a few sections, but we'll just a basic overview and introduction. We'll lay the landscape out nice and clear. We'll go through centralised finance, the established framework of how the global economy has been operating. And then we'll deep dive into decentralised finance and some examples and what are the benefits to the global economy and the threats to the standard centralised finance system. We'll go through some additional examples and then we'll have a summary at the end. Now, the core aim of this module, we really want to deep dive and explore the two effective operating and contrasting platforms globally within the world of finance. And we'll keep building up the case. So we'll build up the case through centralised finance, how global institutions and governments are structured accordingly, and then compare that against what's been happening in the recent decade, and in particular the last 4 or 5 years, with the rapid adoption of decentralised finance in the world economy. And with these two centralised platforms, when we have a starting point, and again we'll build the case on centralised and the platforms around it. The centralised finance, or as I call CFI, is it's effectively the long established, particularly over the last 100 years, of traditional government, traditional regulatory framework, and how financial institutions operate, how they're regulated, how they make profit, what the fees they charge to their clients and customers globally. And we'll touch on this in more detail, but it includes key and very important financial global institutions called central banks. And we'll do a deep dive into that. Financial deposit institutions, traditional banks, FDIs, commercial lending banks and institutions, importantly regulators in each jurisdiction and globally, asset managers, wealth managers, investment banks, and capital markets in general. And we'll explore how capital markets and the traditional centralised finance effectively control and make a lot of the fees globally, particularly on the equity capital markets, obviously exchange traded listed companies, which is very important, and debt capital markets, where we call it as DCM. So the debt issuers, the people that control and issue the debt on behalf of governments, corporations, it's a key part of the platform of the traditional centralised finance as we build that case. And as we build that case, and then we'll compare the DeFi, the decentralised platform, which really, in effect, is an alternative, which not everybody is comfortable with when you have alternative platforms, given the traditional nature and the regulatory backdrop of the centralised finance operating platform. And the new financial platforms and operating systems, there's some clear benefits to it, but the adoption of it is the key here, as global economies and regulators and governments and central banks and all those traditional institutions we'll keep talking about are part of that old world, traditional, contemporary, current centralised finance, or the CFI. And when decentralised finance increasingly becomes a bigger part of the economy, and say, for example, emerging economies like the continent of Africa, they are early adopters of decentralised finance, given their traditional centralised finance systems aren't as built up as the rest of the world. So they're using those as a bit of to explore and see where the developments are and where the regulators can have a look, because the regulators and governments in general are hesitant to be adopting new technologies that bypass what they've established and monitor on a day-to-day basis. Clearly, the blockchain technology is the key here. It is the primary outcome of removing the intermediary, the middle person. Once we remove the middleman, that is a big game changer, and we'll be exploring that in the decentralized section. We'll also deep dive into lots of examples, time and time again, just use one example after the other to keep building the case of what are the traditional institutions with centralized finance and what are the up and coming decentralized DeFi finance alternatives, and why there's concern with regulators, while the adoption's quite quick, and why at the end of the day there'll be a hybrid model that's underway and developing regardless, that is a little bit of a foot in both camps. These two different opposing paradigms are really a challenge for a lot of governments and regulators, but it also can be a solution if adopted. But generally, what you do find is the traditional developed market institutions are very hesitant, particularly over the last 50 years, to be letting go of what their controls are. And that's obviously overseen by the United Nations and organisations linked to that. Regulators at both the supra, and by supra it means multinational level. The EU, for example, is a classic supra organisation. The EU is the second largest economic region in the world, but it's also a supra with multi-sovereigns within it. But then the United Nations is the ultimate supra organisation. So those organisations tend to be hesitant to significant change, but they can see also the benefits of the blockchain and the challenges ahead. And for some people, it could be alarmed with the threats to centralised finance with the blockchain technology, given it's so seamless in parts. And again, it moves the middleman, which removes fees and revenue for some big players, particularly financial institutions. So let's just go through just the backdrop of this presentation. So we'll aim to wrap it up within that 90-minute framework. Questions at the end, and please enjoy. And there's some additional reference points I have at the end of the presentation that may be useful for those that want to do some deep diving themselves. Let's go into centralized finance and really spend some time building the framework. And this is just a small example of the existing structures within centralized finance, and effectively most of the world operates under that at the moment. And we'll start looking at examples about it, and the themes I want to bring out to resonate with you are that those that have access to cost of capital and capital savings are broadly finite, and they can go anywhere in the world to invest. They're regulated as they invest, and that is effectively the centralized finance world. And the DeFi, the decentralized finance world, is a challenge to it. But let's just break it down and build up the centralized finance and why they are hesitant to allow blockchain technology just bypass them and their regulatory framework. So we'll go through some controls and intermediaries, some regulation and compliance, which is critical to the traditional CeFi, centralized finance world. We'll talk about trust and third parties, and then compare that, the trust and how that works in the blockchain with the verification that's automatic. And obviously you don't need the middleman. We're talking about liquidity, which is a key function for all economies globally, and then centralized decision-making in some institutions. So let's just spend a bit of time on the summary here as we go through it. But when looking at central banks, and we'll explore central banks like the Saudi Central Bank, the ECB, the European Central Bank that was formed in 1998, and even the Bank of England, one of the oldest central banks in the world, formed in 1694. And what you find is that with central banks, they're the key traditional centralized finance platform where they're obviously trying to create price stability and a functioning economy, and they've been doing it for many generations. And governments and regulators and the whole global investment processes and regulations is linked to those institutions of central banks, which are key policy makers and decision makers. They control the money supply, they control interest rate settings, they issue the debt on behalf of governments around the world, and monitor other programs and currency as well. And then there's the other key institutions, and when we talk about financial deposit institutions or the FDIs, we're just thinking of traditional banks. So think of HSBC. That's one of the largest in the world, and that's what we're thinking about there. They take deposits around the world in both emerging and developed economies, and they're well capitalized, well regulated, and a key example of how one of the large banks in the centralized finance CFI world operates. I think of HSBC when we talk about that. Then we've got commercial banks, lending organizations, and they could be many, but for example, Deutsche Bank is a very key global lender to institutions globally. So that's just an example. Regulators are a key driver, a key referee of global flow of capital and verification within a traditional centralized finance world. And regulators are first and foremost somewhat uncomfortable with the middleman and the blockchain technology. They're trying to work hard and trying to understand a better handle on it. And that's why I would conclude that a blend of the CFI and DeFi platforms is where it will all end up. But we'll go through these traditional institutions, and regulators are a key driver of what happens going forward. Asset managers are fund managers. They're there to invest in the various asset classes, equities, fixed income, property, private equity, venture capital. They're just some examples of various asset classes. Wealth managers replicate what asset managers do, but they talk and work probably with a HSBC private bank, and they're the key advisors of banks within this centralized traditional framework, and one of the fastest growing wealth manager and asset managers in the world is the Middle East, for the sole obvious reason that the Middle East has got savings growing, which is key finite capital at a very rapid pace, and those with the savings globally have that ability to invest globally. So the growth of savings within the Middle East in general is leading to the growth of wealth management organisations as well, and HSBC will be the beneficiaries of that within the traditional centralised finance. Investment banks are pretty critical. They're there to help with deal flow, deal making between corporations globally within the traditional CFI world. And these investment banks work between emerging economies and developed economies. So those extracting resources out of emerging continent of Africa into some developed countries as well. So the investment banks are the ones that are in there organising those deals and transactions, and they don't want to be left out by a blockchain technology. And capital markets are critical. Capital markets effectively for well over 50 years have been the key driver of finite capital savings, and again establishing in the centralized finance world that the Middle East is the fastest growing region in the world with savings, and that's important. And capital markets effectively are creating the opportunities for investment in the emerging world and in the developed world. And capital market could be things like equity capital markets, so raising capital for listed companies, listed oil companies, LNG producers, or car makers, for example, industrial companies, financial firms. So that's pretty standard, and that all forms, and it's a very key part of creating revenue and profits for these organisations. It's controlled and regulated. Again, they don't want the blockchain to remove them. And debt capital markets, those who issue debt instruments on behalf of corporations to assist them through the cycle, whatever it may be, for large capex investments into LNG. LNG is a very capital intensive for obvious reasons. You need multi-decades to get your return on capital on that. A debt instrument will be a very key part of facilitating that large investment up front that would take 20 to 30 years to pay back the investor. So the debt capital market teams is very critical there. They blend it, and again, they don't need the blockchain technology to remove them. They're making good money by offering that. But I'm using the LNG example because it's so capital intensive. It needs multi-decades to return that to the investor, and it's obviously the key transition fuel going forward. The traditional centralized finance, again, it's very established, does not want to be superseded by the new blockchain technology. They see it as a threat to their profits. They're adopting it internally to understand how they can adopt it themselves. The centralized finance, again, time and time again, it is a very, very centralized and highly, highly regulated platform. And that is what the regulators are comfortable with. And they're very uncomfortable with the blockchain technology if they're not included. So governments and regulators, generally the regulators believe they have a more trusted environment because they've been doing it this way for some time. And the blockchain technology, again, is trying to fast track and remove them, which we'll use those examples later on. But globally, many sovereigns and governments in general, they have the key inputs into these key global supranational institutions. So they contributed to the United Nations, they contributed to World Economic Forum, the International Monetary Fund, the OECD, etc. So the key global players, they contribute to these organisations which oversee the money flow, the trade, etc. around the world, the financial system, the settlement of transactions, the settlement of currency trades, bond trades, equity trades, the movement of capital globally. That is all highly regulated. And in that traditional centralized finance world, blockchain can just do it more efficiently. And that is what is making them a little bit alert and alarmed. And that's why they're putting even more barriers around to monitor and review and to see the adoption of that decentralized finance. CFI institutions and the constituents tend to emphasize the benefits of the traditional platforms, but in reality, they're more comfortable with it. Most of the world operates under that platform, and they're very hesitant for a fast pace of change. And given the status quo of how the world economy is operating at the moment. Now we'll go and do a little bit more of that deep dive there. But in this list here of the traditional financial institutions, we discuss the commercial banks, the deposit takers, and that's like an HSBC. That's a good example. You got brokerage firms, wealth managers, asset managers. But importantly, what I'd like to flag also, the reason why the Middle East is one of the fastest growing areas of savings in the world is their success in the sovereign wealth funds. So sovereign wealth funds are effectively key funds operated by the governments of the region, and they're investing for future generations, which is critical. And we'll explore and have a look at the influence they have and the influence they have in the both centralised CFI world and any adoption, even if it's a small amount of adoption, into the decentralised or DeFi world. Pension funds effectively replicate what sovereign wealth funds do, but they're doing it on behalf of their members around the world. So in Europe, the workers, they'll be administered by, and their retirement savings are managed by a pension fund, and they replicate what a sovereign wealth fund does. Invest in various asset allocation models. Strategic asset allocation is what the economists call it in Finance 101. They have a blend of assets across all asset classes that over multi-decades meet their liabilities to pay their pension schemes. So that's basically what they're doing. And the pension funds replicate effectively what a sovereign wealth fund does. Family offices, a little bit different. They also invest for multi-generations. But as we go down that list, they're basically more adoptive of new technologies. But in general, a lot of the family offices and the wealth they create, they are investing for future generations. And we'll look at some examples of that. And then centralized exchanges. So when you buy equities on an exchange, like the DAX in Germany, and then you've got the CAC in France, and then you've got the FTSE in the UK. So centralized exchanges are key. And these are all established institutions that control the bulk of the wealth around the world, trillions of dollars per day in that centralized finance world. And they're very, very hesitant to allow the blockchain technology to replicate them and replace them. And that is why, again, the adoption of a little bit of both would be probably the middle ground at the end. So we're going to go through some of these key examples of these intermediaries in the established centralized world. We've got to keep building this case up and slowly build the story up why it's so important. But the European Central Bank, the Bank of England, and the Saudi Central Bank are just three of the key central banks globally that are very instrumental. So all central banks are very key in operating all economies. They are there for monetary policy. They are interest rate settings, which is critical. They control money supply settings. So obviously, if you create more money supply, all things being equal, you create more inflation going forward. And the reverse, if you contract the money supply, you are doing everything you can to put some downward pressure on inflation. They are also there for currency transactions and work with the regulators within their economies, their governments, and within their regions. So central banks are critical in the establishment of the centralized finance system, always have been. And they are also looking at what's happening in the blockchain technologies and the decentralized finance. An example will be a central bank digital currency. We'll speak about it later. The CBDC is effectively a version of just digital currency on the blockchain that they're exploring with. One of the countries doing that and has been an early adopter of that program and experiment about 4 or 5 years ago is China, and the People's Bank of China, the PBOC, the Chinese central bank, and China being the second largest economy as a sovereign in the world, have been working on that experiment at a very large scale there. So the central banks are very key monetary policy participants on behalf of their governments. Many are independent, and it's all about price stability. Supranationals, these are critical institutions that exist, have been established in the C5 centralized finance world, and they're controlled, remember, influenced by sovereigns and their regulators who, remember, are very hesitant on the blockchain and the DeFi risks. So the International Monetary Fund is pretty critical, the IMF, the Organisation for Economic Cooperation and Development, the OECD, that's quite critical. These are funded by governments around the world. They're funded by their regulators. The Asian Development Bank, the ADB, likewise, is funded by sovereigns within the Asia Pacific region. They're headquartered, for example, in Manila, OECD headquartered in Paris. They are also debt issuers for a lot of emerging markets. They tend to go into, for example, to assist economies like, say, Argentina, that are in a debt restructuring from their new government at the moment. So they'll be in there trying to work out some debt restructuring programs. And they are backed and supported by the sovereigns of the world. All the sovereigns of the world are the guarantors on behalf of those supranational organisations who are with the World Bank, who issue debt on their behalf to assist governments if they develop certain programs. And that's how you can tell that the centralised finance world is critical in the flow of capital, the issuance of debt, the issuance of equity. And again, those who've got finite savings, which is very hard, and the fastest growing again is the Middle East, they have the ability and the best opportunity to invest at home or abroad. Banks, very established, very hesitant for change. And we discussed the commercial banks, FDI, deposit takers like HSBC, capital markets. We discussed, examples like UBS as well, and Deutsche Bank as some of the examples. Regulatory capital is a very key part of the centralised world. A lot of these banks have what they call regulatory capital or Tier 1 capital. A lot of them have to have at least between 10 and 14% of regulatory capital put aside that they can't touch relative to their deposit base. And then outside of the regulatory capital or the Tier 1 capital that they have to have in there for emergencies, they need to they tend to have non-regulatory capital buffers as well. The point is the regulators step in. The centralised finance world is very hesitant to take a lot of risk. There's been enough bank defaults in the developed and developing economies over the past 50 years. But nevertheless, regulators step in and create more regulation within that traditional centralised finance world. And that you'll find that Tier 1 capital, or the capital forced by banks to put aside, has increased a little bit or significantly since the world events of 2008, 2009, and then the credit crunches from 2010 to 2014, where there's a lot of pressure on financial banks in the Western world, in Europe and North America, and regulators have come in to regulate it some more. But these are all traditional entity structures, and they're very, very, again, hesitant to be using blockchain technology to bypass the regulators. Otherwise, these banks and institutions, they'll believe, won't have that buffer of capital set aside, even though it can. Sovereign wealth funds, we discussed that, and this is very important, the sovereign wealth funds. Again, it's very important for all of you listening, given the Middle East, again, is one of the fastest growing wealth regions in the world. This is important. Those with the finite capital can invest anywhere and therefore have the best opportunity for returns. So the public investment fund is just one example. That's the sovereign nation of Saudi, of course. So that's very, very large and growing quite well. Abu Dhabi as well, UAE, and then Norway's always had a government pension fund for well over 50 years, and it's been doing quite well. It's $1.5 trillion now, and that's just, it started with their obviously their oil revenues. You can see these are resource-based economies, and they put their funds aside and for future generations, and they invest at home or abroad, predominantly abroad, for the decades ahead. So let's just look at a central bank. So the European Central Bank, it was formed in 1998, and it bypassed a lot of traditional central banks, a lot of sovereigns that represents in Europe that were around for hundreds of years. And I encourage you all to go onto their websites. You get free research and publications, statistics, monetary policy. It's open, it's transparent, and these are the gatekeepers of monetary policy on behalf of their governments or their regions, and in this case, the EU, for all the nations in the EU. And again, they are controlling interest rate settings. This is a screenshot from July, but it's gone up to 475. You can see the interest rate settings. You can see implied futures rate settings, information. So it's all the information is controlled, verified. It's under the centralized finance model. And again, policymakers of these central banks are just quite critical. They set interest rates, they set monetary policy, they adjust money supply, and all in the pursuit of price stability. Price stability is their primary aim. And once you have price stability and get on top of it rising inflation, you create more certainty for future investors, and the sovereign wealth funds like that. They need to have a bit more certainty in the jurisdictions they're investing in for the multi-decades ahead, and that's what it's all about. And having good monetary policy on behalf of governments and regions, and in this case the EU, is critical. But I encourage everyone, again, all central banks have very open, transparent, and I've just done a screenshot here, but this is a classic and important institution globally. And we just also could do the same for the Bank of England. So it was formed in 1694, so 330 years old. And again, it sets interest rate settings, which impacts investors. It's got a lot of information, education, and it's in there trying to explain why it's creating the price, why it's creating these interest rate settings, why it's trying to do this education process to amplify what it's doing on behalf of the government and the control of money supply. But it's all sitting there, and this is all centralized finance. The blockchain can bypass what they do effectively, but that ain't going to happen in a hurry. And that is why these central banks around the world, and I use the example of the Chinese, the PBOC, the People's Bank of China, is experimenting with the central bank digital currency, CBDC, on the blockchain. So it's using to how they can adopt it. Another way to look at it, just high level, there's about $55 trillion globally in the development of cash or in bank deposits, and about 5 trillion of that, or 10% of that, just over, is actually in currency or hard currency, what we call fiat. So it's in notes. So already most of the deposits in the world, they're not backed by fiat. They don't have the money printed for it. So you effectively advance your way into some hybrid model anyway. But I'm just using that example, just high level, that fiat currency, or paper money, as they say, is not the dominant form of currency, given a lot of the deposits globally in these banks are now digital anyway. Now, why am I showing you the global growth? This is another, so the OECD, the IMF, they create a lot of this economic data this economic data is overseen by sovereigns around the world and regulators. So governments, regulators, centralized finance, they are members of these global institutions, the IMF, they're members of the OECD, and they contribute, and this is how the world economy operates. And I just thought I'd just show you some global growth data and how it works, and how these super organizations like the IMF and the OECD are key platforms that collect the data that comes from the governments and the regulators of the sovereigns that own and are members of these super. That's why, and it's important to understand how the platform works. So we've got global growth here very quickly. We've got the developed world and the developing world. This is real GDP, so it removes inflation. This is annual GDP. It's a monthly series, and we're just looking at world growth since 2000, 2001. The blue line very quickly here, that's the world growth. The orange line here is the developed economies, and the red one here is the developing emerging economies. The thing to reinforce is that recessions are rare, they're not very frequent, first and foremost. The traditional global economy, traditional centralized finance, or the economic data shows that recessions are rare. That is why earnings expand more than contract. That's the rule of thumb. But what you've seen here in the 2008-2009 recession, the emerging world did not exhibit that, just the developed world. In this, the COVID pandemic, the world economy went offline, so everybody went offline. And so those negative ones were obviously countered by the very strong growth year on year for the next one. So that fall there to that growth there just evens out a little bit. But the point to reinforce here is that emerging economies are growing quicker than developed economies, and that makes a lot of sense. But this economic data, again, is part of the key centralized finance platform. It is data collected by sovereigns, regulated by those sovereigns, overseen by those governments, contributed to these IMF, OECD global super institutions that are owned by effectively governments and sovereigns. So they're not too happy with any blockchain going around it, but that's the traditional economy. And in this, I'm just showing you as an example, the traditional landscape for economic activity, how it's measured and why it's measured. Let's have a bit of a look here and a bit of a deep dive on this data, because I think it's quite important. So while global growth at the moment, it's obviously expanding at different rates, and it rarely contracts. So again, rarely contracts. So so the baseline growth effectively is global growth from 3.5% to 3%, and then slightly lower for the year ahead. So that's what we're looking at. And advanced economies, they can't grow as fast, but around that 2.5%, 2.6%, and falling as they've got those high interest rate settings. And emerging and developing markets, very uneven depending which continent you go to, but they're hovering around in aggregate with a very large range around that 4% as they get on top of inflation. But the thing to highlight, I'd like to show you here is that global output, so that's an actual number. That's about 3/4 about right. They've got most of the data in for that, with a couple of months to contribute there. And some of the smaller economies take a few more months. About March next year, you get the revisions. And then we're looking at about a 2.9 for the global growth. And advanced economies, we're looking at a slowdown here. The emerging ones, looking at a bit of a flatliner, but that's not the story. It's a big variance, like I was trying to highlight here. So the variance is China had a slow, obviously it locked up in the pandemic. It's accelerated quickly this year, and it will slow down next year. But let's just have a look at the largest economy in the Middle East by far, and the Saudi economy. It was really quite strong growth coming out of the global pandemic. So nearly 9% growth is quite exceptional. Just under 1% for this year. It'll probably sit around that 0.91%, and then re-accelerates next year there. And that is a big play. So you can see the variance. So globally, the emerging markets there, but someone like the largest economy there is in there. So again, these super organizations within the centralized finance platform, operated and controlled by regulators and sovereigns around the world. It's good, open, transparent data. You can go on their websites. You've got the central banks as well. But just to show you that this is what decentralized finance is trying to replicate their own platform. It won't be doing it really, but we'll just look at some of the advantages of the blockchain technology, but it won't be to supersede these supranational organizations. This is quite important characteristic. I'll just throw this in just for a bit of, it's quite useful, but economies globally by size. So you got the US, you got the European region, you got China. China's the second largest economy globally, but the EU region is second. And number 4 is Japan, and Japan was number 2, then went number 3, number 4. So it just gives you an idea where the global growth is. And the emerging economies here in Latin America, and then the African continent, they're quite low contributors. But what we'll talk about in the DeFi section is that these low contributors to global growth are the early adopters to the blockchain technology. And that's basically where we're going through. It's just that they see that the traditional pathway to becoming a larger economy through the centralized platform has got high barriers to entry, and it's a high cost of capital. And you'll see that the adoption of decentralized finance is here. So while there's benefits of these large economies here, the smaller ones are very pragmatic. Again, early adopters of blockchain, crypto, currencies, Bitcoin and Ethereum, and we'll explore that. But this is a very good visual of those. And the large economies here, the big contributors to global growth, they're the ones more hesitant on the DeFi platforms, and they're much more hesitant to having anyone go past the middleman, bypass the regulator, and do their banking off their eyesight. So they need to be collecting taxes, they want to be doing many things, but they want to control the narrative, and the blockchain is not going to do it for them. But again, the African continent and the Latin American continent, South America, you can see the smallest economies globally, and that is why they are the adopters of blockchain, and specifically the crypto. I thought I'll also add this table, given I'm really making the point that global savings is key. Global savings is the key driver in the centralized traditional platform. It's a high cost to barrier entry, and sovereign wealth funds control capital. And that is critical because they have the choice of investment over anyone else. And if you're the large investor, you can control the terms of the investment. And that is why the Middle East is in a very beneficial situation versus the globe over the next few decades. As they're transitioning and doing some innovation across all sectors and asset classes, they also have that capital to deploy around the world. And versus, remember, it's a lot of money outright, but in relative terms, it's a lot of money versus other global institutions. And that's why the Middle East is a critical player in the investment platform in the decades ahead by far. They're predominantly in that, that traditional centralized finance segment. Some of them have done some small DeFi, decentralized investments via their venture capital alignments, and GRC and Temasek out of Singapore have been open about it publicly, so I'd mention it here. Others may be, but we don't know, and they're not mentioning it. But you'd have to think that many of them are exploring the blockchain technology. Now, this is pretty important here, given it's these are the top 10 sovereign wealth funds by size. We've got the Norwegian fund, and then you've got the Chinese Investment Corporation, and then we've got another one out of Asia, and then you've got Abu Dhabi, Kuwait, Saudi, then you've got GRC out of Singapore, Hong Kong, Temasek out of Singapore, and Qatar. So out of the top 10, you can quite clearly see all of them except for one is in the Middle East or the Asian region. They are the controllers of capital. Again, I keep repeating it, it's finite. It's on the traditional centralized platform. They are going to increasingly dictate investments, and increasingly their adoption of any blockchain technologies is critical, given the size of these funds relative to the rest of the world. Now, I keep reinforcing these points, but what I'll try and put it in perspective is that, as an example, the top 100 global sovereign wealth funds, they oversee about 12 trillion of assets under management. It's a lot of money. And just to give you an idea, global GDP roughly is around 100 trillion. So these are a very, very large block of investors relative to the size of the global economy. And it's about relativity, and that is key. So while they're under the regulatory centralized finance platforms, their adoption and exploration of blockchain technologies like China, so the Chinese economy, is a critical part of how the platforms work going forward. And that is why you see, for example, the expanding BRIC economies of China, the Middle East, parts of Latin America, parts of Africa, and parts of East Europe is growing ever so quickly. And that's going to be a larger trading bloc that's got a hybrid between centralised and decentralised finance as a backdrop. But that adoption, it comes down to those who control the investments. So hopefully that made a bit of sense there while we're building that case. Now, regulation and compliance. Without a doubt, one of the key drivers of the hesitant nature for developed economies to allow blockchain to remove the middleman, particularly in financial services, is the regulation and compliance. There's very, very strict regulatory frameworks. I gave you examples about regulatory capital for banks. Tier 1 capital between 10 and 14% has to be put aside before they can transact, and there's a high compliance regime. It's a high compliance cost. So anti-money laundering is a very key part. Everyone's got to verify through their algorithms of why money's moving, how they're moving in and out of, for example, HSBC, UBS, Deutsche Bank. They're heavily regulated about every flow of every dollar. And they all have to show to their regulators, where is the client's source of wealth? Where is the client's source of funds for that transaction that they're doing? So it's not, the regulators in the traditional centralised finance world, it's not only good enough for them to find out where the source of funds are coming from for that one transaction that they're doing, but they need to know bigger picture where the source of wealth is for that organisation, that individual, that family, or that family office. Then I need to do key client due diligence processes under this framework, which is know your client. Now, blockchain technology can verify this instantly, but the regulation compliance of sovereign wealth funds and sovereign funds and governments is not too happy about that. They want to keep it under control and know your clients. The regulatory platform is very, very hesitant to be removed as a middle person, a middleman from that transaction. So the focus on regulation and compliance is critical for financial market stability. They keep doing it. There's reputational damage, but without doubt, the regulator, on behalf of the government, is very, very hesitant, and it needs to slowly move into how the blockchain technology, because they prefer the high barriers to entry, where blockchain and decentralized finance are low barriers to entry for finance. And that is a key takeaway that we need to take out of this at this stage. So in the EU, I'm just grabbing it's on the EU website, and then EU Directive for Anti-Money Laundering. They need to, all banks, all institutions need to show verification in their client due diligence of know your client, identify where they are, old school verification. Remember, blockchain verifies instantly, and you don't need a middleman. You don't need anyone to verify anything. Blockchain and decentralized finance bypasses that. Know your customer's business, transaction profile, i.e. the source of funds. Know your customer's transaction, monitoring their transaction and transfers and patterns of flows. Know your employee, staff background checks for a lot of banks, onboarding staff and training, segregation of the digital and the cloud and physical barriers in different departments. You find, for example, in the companies that I work in, outside of the universities day to day, in and out, there's staff that are segregated around the world within the same office with security access that are different in the same firm. And that is a very normal part of the old school regulatory framework, and there's continuous monitoring. The blockchain can bypass all of this, and that is what the regulator is very hesitant about. They need to do it slower. I'm going to look at capital again, very important here. So global family offices and wealth offices there. So what we're trying to look at, family offices, remember we're talking about pension funds. We spoke about sovereign wealth funds. I thought I'd just, if you can keep up with the logic about the source of capital and the source of funds, let's have a look at the billionaires. So these are the individuals, not the government's money, not the pension fund's money on behalf of members for, say, BMW, Mercedes-Benz or Porsche, for example. They have member-run pension funds. These are the individuals that have made $1 billion around the world, so it's private money. They tend to be more adoptive of new technology and blockchain. It's quite interesting, and I'd like to show you this. Now, this data comes from Credit Suisse, and it's from March 2020, before the pandemic. It's changed a little bit, but the thing to reinforce here, out of the top 1,000 billionaires, so remember, sovereign wealth funds are controlled out of the Middle East, the bulk of the money. and Asia. Then you got the pension funds, but the family offices out of the top 1,000 billionaires, just over 350 US, 140-ish China, and Germany 66. Got Russia here, Hong Kong got the traditional ones, but these families here, you've got some traditional ones here, but Europe's got when you collect all of Europe, it seems a reasonable number. But these families have been there, some of them for generations. One generation is a short one, but many have been there for 3 generations, 4. But Gen 1, 2, 3, 4, these are key family offices. They're not controlled by governments. They're regulated on the centralized platform. They are a finite source of capital that's quite rare, and they tend to experiment with new technologies. They're early adopters of new technologies, and some have been early adopters of the decentralized finance platform. So they're things to reinforce that. Once we go to the private wealth space and the billionaires, they are more adoptive of the new technologies versus the traditional platforms and traditional institutions that are overseen by regulators and governments who oversee the super organizations that represent them and report on their behalf. And that is a key thing to reinforce here, that they tend to be that. Now, the cost of compliance and regulation. So compliance is very, very expensive in the developed world, but non-compliance is even more expensive. So there's the cost of fraud and the cost of in the centralized finance world with the regulation. And while the blockchain technology will bypass all of this, governments are very concerned and very hesitant, and are always looking for stability, from their regulators to their central banks and monetary policy to their super organizations. And these headlines will keep coming from time to time, and there will be more and more fines as they're trying to get these organizations to improve. But basically, that's what the platform is from centralized finance. Trust in third parties. This is important to understand with the centralized platform. It's all about safeguarding their assets. This is key. So in the old traditional world that's been around for so long, it's about safeguard of access, safe custody, ring fencing assets, executing transaction, provide services. So the trust is very important, and the institution's reputation and the regulatory oversight. Now, the blockchain bypasses all this. It removes the middleman, and it doesn't need any of this. The trust is that it's verifiable instantly from the transaction, where most of the world and pretty much most of the banking sector globally, and those savings that we were talking about, is in this centralized finance regulatory environment, highly compliant, and the safe custody of assets is critical. So when people are investing, when I say safe custody globally, they will ring fence the assets on behalf of the investor through a large organization, and that could be UBS or Morgan Stanley or BNP Paribas or whatever it may be. They'll ring fence, or State Street, just some examples, and HSBC can be a custodian on your behalf. And in this world, they have these over-the-counter OTC transactions. They're not exchange traded, so they're over-the-counter, and these are big drivers of the fixed income bond market, one of the biggest markets in the world. So the biggest flow of capital for investing for debt issuers. They need savers. Again, the Middle East and Asia, the largest savers on the planet. They're the key drivers of the price of debt and the level of issuance of debt. So sovereign debt, corporate bonds, and in the old world, the current world, each of these have a numbering system that can be bypassed through the blockchain, but regulators are very hesitant on that happening. So when you're buying a bond, it's not exchange traded. Again, it's over the counter, OTC. You transact, there's an identifier to that bond. Remember, bearer bonds are gone. They're the old days, 50, 60 years ago. The holder of that piece of paper is the bearer and gets that money. It's all numbered now. It's all accountable every dollar. So just to reinform that this whole system operates under the regulatory framework. It is a high barrier to entry, but like the blockchain technology can remove this and be a very low barrier to entry, and regulators are not keen on that happening. For example, International Swaps and Derivative Association, these ISDA agreements are so difficult to get that you need effectively, it's to get a regulatory license, you really need over $1 billion to be able to transact in it. So it's a very, very high barrier to entry. And again, the blockchain can just remove it instantly, but the regulators are not allowing that. They're not too keen on it. But again, the OTC bond market drives global capital, and because it's the debt market of the world. And just the ISDA agreement, it's it's non-exchange traded, so not the shares. They just do the swaps, the futures, the derivatives, the forwards, the options, and hedge out currencies, hedge out obviously debt on behalf of the investors, whether they're sovereign wealth funds or pension funds, and the intermediaries, the commercial banks, the brokers, the debt capital markets, equity capital markets. Everybody makes a lot of revenue and profit out of this, and that is another reason why they are very hesitant to allow blockchain technology to remove the middleman, and the operating platform globally. It's going to take a while before regulators adopt blockchain technology to create that the additional efficiencies, but they're just looking at the benefits of it going forward. But again, just reinforcing centralized finance, it drives global finance, it drives global growth, global trade, and the blockchain it's very effective, but it's a low barrier to entry. It's very, very disruptive, but it's still a very, very small part of global transactions. But again, in the emerging world, and I showed you Latin America and the African continent, which are low contributors to global growth, they are early adopters of something like the blockchain. London Stock Exchange, that's one of the oldest in the world. And again, you just log on to have a look at it, but these are established that have evolved over many hundreds of years. But in the last 50 years, a lot of the exchanges they trade cash equities, some derivatives. They're pretty simple. It's exchange traded and OTC. Now let's quickly have a look at liquidity before we do that deep dive into the DeFi. But liquidity is a very key part of all investments. High liquidity is important. Again, whoever's got control of the capital, the Middle East, Asia, sovereign wealth funds, they are the drivers of the investment outcome, and they are the drivers whether they want liquid or non-liquid, and they can hedge themselves out through the over-the-counter market. So exchange traded, it's pretty simple, but it's on the exchange like equities, derivatives, future exchanges. They're well capitalized, and they're key clearing mechanisms for the futures market. It simplifies trading. It's liquidity. All trades are verified and settled daily. Blockchain are verified and settled immediately that second. So these are advanced, but most of the world's on the derivative exchange, and not much of the world's on the blockchain. It's important for liquidity that in the centralized finance, highly regulated, I should say, market, stakeholder confidence is key for over-the-counter. And likewise for bonds, currencies, high barrier to entry. I keep reinforcing the point that the blockchain technology solves this immediately, but the regulators and the institutions that exist around the world are just not going to allow that adoption without their controls. And centralized decision making, just to close it out here, regarding interest rates, lending, borrowing by central entities. Again, it's the central banks, it's the governments that do the fiscal policy settings, the regulators that represent the governments, the regulatory oversee the banking sectors and systems, the super regulatory entities, global organizations out of the UN, and centralized exchanges. These are all driving global capital on behalf of those with finite global wealth. Again, the Middle East and Asia are the biggest savers on the planet, then the pension funds. And this is all part of that regulatory oversight and framework and structure. The blockchain is an instant solution to remove the middleman, have a low barrier to entry, but it's not adopted anywhere near significant versus the global established centralized finance decision-making platform. Which takes us into the decentralized finance platform. So let's just go through this decentralized platform, the openness, the transparency, and then I'm going to give you a real world example of the blend of CeFi and DeFi. And one of the companies I work at globally were the first to adopt a Bitcoin and Ethereum ETF, and so a decentralized finance investment opportunity, but we did it within a centralized finance world. So I'll give you a real world example why we believe, or are making the case and prosecuting the case, that a blended solution is something that's going to probably happen going forward, security and some risks going forward. So decentralized finance, again, we mentioned it time and time again, reflects the different technologies of blockchain, which is the primary aim of removing intermediaries. Removing the middleman is cheaper for both people in the transaction, but it's not how the centralized platform works. It's how the new blockchain technology works. Visible very clearly and via the cryptocurrency with Bitcoin and Ethereum. For what it's worth, I think there's three ways of looking at cryptocurrencies. One is Bitcoin, number two is Ethereum, and number three is everything else. So let's park everything else for now. And it's just too deep of a dive, that one. And we'll just focus on the more mainstream ones of Bitcoin and Ethereum using the blockchain technology. It's obviously the new digital currency. It's a new digital gold. Cryptocurrency keep regulators very, very nervous as the FTX court cases in North America out of the Caribbean were a key case in point over the past 6 months. And then whether you call it, it's a currency in part, because you can use Bitcoin and Ethereum for transaction. And some people would even argue it's an alternative part of a asset class due to its low correlations with conventional asset classes. We haven't had enough data to verify that, but I'm sympathetic to people thinking it's an alternative asset class. But really, a digital currency would be a more mainstream view to have. Again, the blockchain effectively places the transaction at the core of everything. Verification is instant. It bypasses all that identity-driven financial world, where I spent 5 or 6 slides going through the detail of centralized finance. The regulators that oversee that on behalf of their sovereigns, who oversee it on behalf of the super organizations, all of these, whether it's an OTC market or exchange traded, all of this is driven with a high cost of, it's a high barrier to entry, and the blockchain technology instantly verifies and on behalf of the regulator and transacts at a much lower price. And the centralized finance world is not going to allow that to happen. And that is why, again, a hybrid model will be adopted, is our view, or my view. And I use the bearer bond example. Like I said, 50 years ago, you could walk around anywhere in the world. You can turn up to a bank with a bearer bond. It's got no name on it. If you're holding it, you hand that bond over, that certificate, they give you the money back, and you could carry, 1 inch think of bearer bonds could be worth $100 million, and they give it to you, no questions asked. That has completely been removed in the centralized finance world over the last 50 years. They want to control every dollar flowing everywhere in all jurisdictions and all bank accounts on behalf of their governments. And obviously they need to be, you have to pay your taxes. So you have, each jurisdiction's got that requirement. That's by law. It's obviously makes a lot of sense. And that is why they're very hesitant on the blockchain technology that can remove all of this. The blockchains also have the ability, it's effective meritocracy. You can participate no matter how small you are, and you can participate no matter how advanced your economy is. So let's go back to those examples. Why I showed you the GDP and global chart, and why I showed you the size of activity. So remember, Middle East is very strong economic activity, very strong growth. We showed you the Saudi economy being the biggest economy within the region. So that's a strong hub. Parts of North Africa would be. Asia's very, very strong, and you've got the developed world. But when you look at most of core Africa and most of Latin America, they are small contributions to global growth. Their institutions are under more pressure and challenges. Their governments, their regulators, their central banks, their financial entities and deposit takers, their financial firms under more pressure. So they are more likely to be an adopter and are an adopter of blockchain technologies and Bitcoin and Ethereum for transactions. So for example, old technologies don't have to be rolled out in core Africa. Most of core Africa, approaching 75%, have a mobile phone. So they're available with a mini computer to be a business, a bank, a crypto exchange transaction. So they are available. And that is why those continents where you find more early adopters of the crypto, which has moved over the last 5, 6, 7 years into the developed world. And given that the DeFi, decentralized finance world offers that lower regulatory oversight, lower government controls. Traditional institutions in the developed world are very concerned that blockchain sidesteps these traditional centralized monetary organizations, again, like central banks and their regulators. But remember, one of the examples I gave earlier on in the talk was the central bank digital currencies, the CBDCs, which is a form of blockchain currency, digital currency. And the largest experiment of that is going on in China. The People's Bank of China, the PBOC, is doing that on behalf of the government in Beijing. And that would be a very key learning point, because the sample's so big, of how it's going to be going forward. But regulators and government not comfortable with it, but the early adopters were the smaller contributors to global growth, and now it's becoming more mainstream, and has led to the pragmatic nature of some central banks exploring the CBDC, the central bank digital currency, and adopting the concepts of blockchain. Decentralized Finance 101, smart contracts, and obviously removing the intermediaries. But we spoke about Bitcoin and Ethereum, and in section 2, we explored that the aggregated and centralized platforms, they exist. Everything about the regulator and the centralized platform exists, but they don't trust anybody before or during the transaction. That is why the verification has to happen on all sides. So if it's an over-the-counter bond transaction, you need to have a high cost of barrier, high barriers to entry. Is there agreements over $1 billion in the market? You need to be effectively, these high barriers means a form of membership to be able to transact in the debt markets. And the blockchain effectively does the opposite of that. It basically says anyone can invest, whether it's $1 up to $1 billion or more, and that is not what the regulators are ready for in the global platform, just to reinforce that. And the blockchain, that secure decentralization effectively is a version of trust that's live, but in the centralized finance world, it is very much a version that trust removing the middleman is not a good thing. So you got two different opposing views about that, and that is why a hybrid model probably is the best one. Now, why would something like Ethereum and Bitcoin be so popular? Again, I made the case that it's popular because Africa and Latin America, they contribute less to GDP effectively with low barriers to entry. Instead of adopting a centralized finance high cost structure and model, and again, most early adopters with mobile phones, that's where it was transacting, coming out of the GFC as a good alternative, and it's been adopted in the Western world very quickly. So the credit crunch in the GFC led to this becoming a little bit more mainstream, and did a lot of the work for blockchain technology, where particularly in the last 5 years, it's pushed its way into more mainstream transactions, where some municipals around the world would use it as a form of payment, which is quite interesting, and some companies invest in it as well. But the decentralized blockchain network also, again, it scares the centralized regulators, but it offers enhanced security and verification. It's instant, it's meritocracy, low barriers to entry, and small transactions, so they can play like the big players around the world. And by bypassing these security networks that are what they believe analog in nature, they believe they can transact, protect themselves, and it's a much lower fee structure. So saving €5 per transaction for someone in an emerging world in Africa or Latin America is a significant portion of that transaction cost versus someone sitting in Dubai or Paris, for example, just making that up. So the costs are so high that the barrier to entry, that the blockchain, the meritocracy really works. So it's a lower cost, and that's why it's got such a vast adoption of these economies in, again, Africa and Latin America, but they're small economies versus the global ones. So it means a lot to them for that saving and that meritocracy. So also the rise of cyber attacks within the centralized finance world, a lot of compliance costs go into that, and the sophistication of that is quite high and alarming for banks. The blockchain can bypass that as well. So the benefits are it's very difficult to corrupt the blockchain network, and while people are trying to test it at a grand scale, broadly it's holding up. And in the centralized traditional world, the cost of compliance and cyber attacks is just going one direction, and that is up, hence the high barriers to entry. The openness nature of the decentralized finance is also quite important, but it's also, it instantly does know your client. It instantly verifies the transaction and settles it. This permissionless characteristic within cryptos really is a big concern for governments and the regulators of the traditional, and that is why they're not keen on that dominating their economies. But once fund arrives from crypto into conventional bank accounts into the fiat, so fiat currency is the currency. It's the euro. If you live in Europe, that's a version of fiat currency. And once it comes into that form, then the authorities, it meets the regulatory framework. But if the blockchain to blockchain and Ethereum and Bitcoin stay within their platforms in the DeFi, the decentralized finance, it's very hard for regulators to track. But once it lands into a bank account somewhere in the world, well, then it has to be fulfilling their know your client. Is there any anti-money laundering? What's your source of wealth? What's your source of funds? Once it goes into there, the regulators will be please explain. And that's happening more and more as people are playing the two platforms increasingly, because they need to transact in property or whatever they may do is required. The transparency is also a very key driver of the pillar of trust for the blockchain, because it's instantaneous, low cost, low barriers to entry, and it reflects the primary aim of what, again, removing the middleman is the primary benefit, low cost, instantaneous verification of the strategy. And in the centralized finance world, it is really making those regulators very, very, very uncomfortable. And some examples when looking at it, and we're going to go through it, is that it's the benefits of blockchains, while numerous, some examples of blending the two, we're going to go through very, very soon. But to establish trust again in the cryptocurrency, it's effectively a consensus meritocracy mechanism, and everything's authenticated at a low cost at the same time. And the opportunity to commit fraud, very, very difficult versus the centralized finance world. So in the centralized finance world, cyber attacks are up. There's a lot of fraud. There's identity theft. You lose your money, you can't get it back. That's not going to happen. That won't happen with the blockchain technology. So there's a low cost. So low cost of barriers to operate, low cost to be operating in that platform on the blockchain. And the public ledger is much more traceable and transparent as a protective mechanism versus a centralized. But again, the system is the centralized finance, and the regulators don't want to adopt the blockchain without their control. So you're sort of stuck between the two. But the cost of fraud within a centralized finance world is quite high. And even something is, if you transact in the traditional decentralized finance world and you want to send something back for goods, you've got to wait for the money to come back a few weeks later. That just reverses instantly in the blockchain world. So adopting a little bit of both will be the path of least resistance, but at the moment, the benefits of blockchain are not being utilized in the centralized for the reasons I keep reinforcing, that they're very uncomfortable as regulators. So we're going to go through in the next couple of slides, and this is pretty important because it's actually happening. And I was involved in doing the first Bitcoin and Ethereum ETF, and so we use it also with some universities as well, some research, but listing these exchange traded funds. So not to sound too confusing, but in the traditional decentralized finance, DeFi world, the blockchain technology, the most mainstream ones that we all know are Bitcoin and Ethereum. They stay in that network, low barriers to entry, transaction verification, and it is quite seamless. Now, some people in the centralized finance world who don't want to go over to the decentralized finance world wanted to invest in crypto via Bitcoin and Ethereum. So this is when the two DeFi and CeFi came together, and it created complexities which we had to solve and sort. An exchange-traded fund, an ETF, is listed on an exchange. We spoke about exchanges like the London Stock Exchange, the DAX out of Germany, the CAC out of France, and in those in that, it's usually a pool of assets. It could be a portfolio of stocks, could be a portfolio of fixed income, portfolio of properties, or in this case, Bitcoin or Ethereum. They wanted to do it for some diversification, but they also wanted to do it because they didn't want to go over to the definance world. It sounds at the beginning really odd that someone wants the benefits of the DeFi, but they want to have it in the world of the CeFi with the regulation. But that's what they wanted. And once you have an investment in the centralized finance world, you need high barriers of entry, a prospectus or a product disclosure statement that is very big document that needs to meet regulatory requirements. So hopefully I made the case there. So people in the CeFi world did not want to go over to the DeFi world to invest in Bitcoin and Ethereum like others are doing and adopting very quickly. They wanted to invest it into a portfolio listed on an exchange called an ETF, and that is regulated by the CeFi. So it really is quite an interesting development and how it happened. And we launched a couple of those ourselves with some help with some universities. So this is an actual cut and paste from our product disclosure statement of a Bitcoin. So this wouldn't have to happen in the DeFi world. You buy the Bitcoin, you transact in the Bitcoin, you buy and sell in the Bitcoin, and it stays, ledger verified, low barrier to entry. But once we had to put the portfolio together in the centralized finance operating platform, and by this stage of the lecture, you must understand that by now the high cost of barriers, the regulation is very high in the centralized finance traditional. So all of this had to be created, a lot of legal works and product disclosure statements to create this exchange traded fund. It's quite unique and very interesting that this happened. And listing this exchange traded fund for Bitcoin and also for Ethereum was well received, but it is a volatile asset class. But it was surprising, and that is why people like myself are concluding that a blockchain decentralized finance with a bit of centralized finance hybrid would work, the central bank digital currency. But the benefits of the blockchain are so important that just can't be excused by the regulators that are very nervous with it going forward. But just to give you an idea, a 50-page document had to be written for something that is instantaneous in the definance world to be available for people to invest in an exchange traded fund that's listed on an exchange. And these it is available to retail wholesale investors, but the regulators' requirements involves 50 pages of defining it, the risks, etc. So I thought that's quite unique to bring to your attention, because this is happening in Canada, it's happening in Europe, it's happening in Brazil as well. So economies that have adopted, the 5 first economies that adopted some form of crypto financial services are Brazil, Switzerland, Singapore, and Australia was some of those that adopted it. But it's a high cost of barrier that they created for it. This is also very interesting, just these 2 dot points there. The whole point of blockchain is to, again, low barrier to entry, transact, remove the middleman, and have low costs with everything you do. While offering a Bitcoin and Ethereum exchange traded fund, you've absolutely increased the costs. And this is what happened in our examples. It increased the cost because that's what they wanted. And there had to be a safe custody arrangement that makes no sense on the ledger on the blockchain, but within the central finance, the regulators wanted a segregation of safe custody. So the inventors of Bitcoin had to go and create a firm called Gemini, which acted as the custodian, which ring-fenced the assets. Now that in itself, if you understood what I said, that's quite unique and quite amusing. But the benefits that the blockchain to invest in this in the centralized finance, the regulators really made them effectively high cost of barriers and created a lot of cost for it in this. It's like a new technology dropped into a traditional platform, and it's quite unique. But people just wanted to invest in it within their centralized finance operating system or their banks. They did not want to go into the blockchain, which is quite unique. I'm just going to show you, this is what is one of the ETFs that are listed on the exchange. This one's a Bitcoin one, there's the Ethereum one. There's now there's quite a few that are popping up around the world. Now, the low cost structure that you want for using the Bitcoin and Ethereum is effectively non-existent once you have an ETF, because you're grabbing the low cost structure, low barrier to entry, you're moving that investment into the centralized finance traditional world, and the lower cost benefits are just watered away. But nevertheless, people had a chance because this is what they're doing very quickly. I mean, have a look at it. Within 18 months, you've had Bitcoin traded 18,000, and now it's around 44,000. That is an extraordinary rally. Back in 2013, it's $13. At the end of that year, $760. A lot of people are selling and very happy with that. And you think about it up here, it traded, around $66,000 as well. So it's at its peak up here. So very volatile. That's the opportunities with the Bitcoin there investment. So it's a volatile commodity. We haven't got enough data to verify if it's got low correlations with other asset classes. It is still a little bit vulnerable, the blockchain, but nevertheless, it's holding up given all these challenges, because that Bitcoin price that we showed you, that chart here, that is both in a high and low interest rate environment. There's some good data with some very good different macro drivers that now you could sit there and make the case that it is volatile like a currency, but it's quite useful as an alternative versus other investments. So that market volatility is still there like traditional ones, but again, it's moving with both high and low interest rates. And when monetary policy through central banks, when they sharply move interest rates, that sharply changes future credit conditions and future earnings conditions. And that leads to bond volatility, currency volatility, and equity market volatility as you try and be predictive of what those monetary policy moves do. So in light of all of that, the volatility is already there in traditional centralized finance. So you'd expect volatility in crypto as well, but it seems to be exhibiting some interesting characteristics there by the blockchain technology. I will look at some other things just to reflect on with decentralized finance, if I may. One of the benefits of the blockchain network, because of its low barrier to entry and the instantaneous nature, it can collect data like a bank would on credit quality of a corporation, of an individual, and it can evaluate credit worthiness pretty much instantaneously with the verification of metrics and risks. That can lower so many costs and can create so many more transactions versus what they are at the moment, because the system, again, high barriers to entry. So they're things that can be utilized. So emerging economies who have a high cost of barrier to grow their institutions to meet the size, say, out of Europe and the Middle East, they may say, well, I'll start using more of the blockchain because it's a low cost for transaction. And you can evaluate, and the data you can get from creditworthiness. So some of the traditional banks now are having experiments where they're adopting blockchain technologies to verify the creditworthiness to help them streamline and hopefully lower costs, and hopefully pass that on, because that's what the decentralized finance is all about, lowering the costs for participants. A lot of these credit agencies who need to evaluate this credit, to make these investment valuations, they create a lot of trading opportunities. So if they can utilize the blockchain technology, you get better quality big data instantaneously at a lower cost, which has got to help investment valuation decision making. And if you help that, the largest savers on the planet out of Asia and the Middle East, they get to choose that investment outcome and the price for it. So consumer credit ratings, sovereign credit ratings, also efficient money transfers between the emerging and developed economies. That's the main sort of benefit of it, and that's involved in becoming larger. People can also use it obviously for transactions from day to day, and it's a store of value that's perpetual. And the example of the store of value that I gave was how these blockchain and Ethereum exchange traded funds were formed, which is very strange in a centralized finance, high regulatory environment, which is a high cost, but people wanted exposure to it in that platform, acknowledging they didn't want to go to the cheaper platform. So it just shows you that it's becoming a store of value as well as a form of digital currency. And another one, of course, that can change and be a real big game changer is the insurance sector globally, that has been doing one thing in the past decade with their premiums and raising their premiums and trying to manage their risks. But another form of risk mitigation is the additional data and information that's instantaneous in reporting, and even the audits coming from the blockchain technology. There are some extraordinary benefits that can be adopted, but again, the centralized platform is very hesitant. They're doing it, but they're just doing it ever so slowly versus the blockchain or the decentralized finance platform. Now, I'm going to spend the last 5 to 10 minutes just going through some examples before I summarize, but not too many. But these additional examples are the cost to firms and reputations in the centralized finance world is the reason why regulation keeps becoming more expensive, and is why it's such a high barrier to entry in the centralized finance world. And I like going through a bit of history there, but in case study one, there was a bank that was a UK bank called Barings Bank. It was formed in 1762, and in 1995, it lost $827 million, which had to be sold for $1 to a Dutch bank. And that was the biggest failure of a bank at that time, which is a classic case of non-regulated practices on a futures exchange in Singapore with their head office in London. But the point being is the centralized finance world has this high barrier to entry, and it has this high regulatory oversight for legitimate reasons. It feels that it needs to respond to these types of bank failures around the world, and that's in 1995. And they increased regulatory barriers and requirements. And this led to, in 2011, UBS, which is obviously the biggest bank in Switzerland, being the only bank of the size in Switzerland, had a $2 billion loss in that year from, again, systems failures at the time, and that reputational damage of that $2 billion. So regulation, again, was enhanced. Regulation following this 2011 event became more expensive. You can bypass it all through the decentralized finance platform, but I'm just making the case of why regulators are so hesitant, because they keep creating more barriers and higher barriers and more regulation to try and avert bank failures and like these. Because at the end of the day, one of the classic economists in the world a long time ago said the market can stay rational longer than you can stay solvent. So rational expectations need to be put into some form of perspective here, but the decentralized platform offers a lot of solutions today, instantly. But the thing to reinforce here is that the centralized platform is controlling the system globally and is keeping an eye on it. I'll bypass this one here and just go straight to the summary in the interest of time. Just looking at the capital structure there, which is quite useful. But so in summary, again, just to reinforce, the centralized finance reflects that long-term conventional, traditional government, traditional financial institutions, and the regulatory environment, and they're very hesitant for change that they can't monitor themselves. It includes the central banks. We went through examples of that. Financial deposit institutions. We went through the HSBC example, commercial banks like Deutsche Bank, regulators, asset managers, wealth managers. We went through the finance structure of the centralized finance world. It's more traditional, it's established, and it's very regulated. Because of those examples I showed you with the defaults, they want to control and regulate, and that's why regulatory capital is so high. So governments believe they offer the more trusted environment, and again, most of the world operates on that, so they're effectively correct. The sovereigns have a large say in these global supranational institutions about the trust protocols, and that is why I explained these supranationals, IMF, OECD, via the UN, etc., all sponsored by governments around the world, and they want to regulate where your source of funds comes from, where your source of wealth comes from. Even though the blockchain technology solves for that, it makes them nervous that they can't have any oversight of that. But I showed you the blend of the two at the time, where you can do an ETF, exchange traded fund, of the decentralized platform, blockchain, cryptocurrencies like Bitcoin and Ethereum within the centralized finance, high cost, high barrier to entry world, which is quite unique that exists, but that's what people want to do. The blockchain technology is the most visible by cryptocurrencies, just to reinforce that blockchain technology really is a big game changer, but it's not widely adopted as a size of the global economy. And that's the important thing to highlight. It is widely adopted by population size versus the world, but not by size of the economy. And that is key. It's the verification, the simplicity of it. It can really assist the regulators, but again, they're going to be doing it slowly and monitoring the developments of what the blockchain and the way the ledger can effectively verify instantaneously and create additional data for credit quality. The meritocracy and the low barriers to entry, again, is the reason why the emerging world will increasingly be using this going forward, because you just need a mobile phone and you're effectively a business or a bank. The barriers of entry, again, just to reinforce, are just so low, and the lower regulatory environment. But the solution for some of these banks are the experiment with China that I gave earlier on a couple of times, the central bank digital currency. So the blockchain technology, the smart contracts, it is a peer-to-peer, efficient, low cost of barrier, meritocracy, highly verifiable, transparent platform, but it doesn't control the world finances, and the regulators will keep reviewing this and the oversight. And whenever the money comes out of the blockchain via the currencies, via Bitcoin and Ethereum, into a fiat or into a bank account, it's a please explain, and that's when the traditional regulatory environments kick in banks. So with that, I've enjoyed the last 90 minutes with you. I thank you very much for your attention. And again, if I can ask you to please scan the QR code that's on your screen. And if you've got time, please take that survey. And we appreciate your time to spend and to listen in on the centralized finance versus decentralized finance with those working examples. Thank you very much.